Imagine the morning sun hitting the coast of Taiwan. You wake up without an alarm. No commute, no deadlines, just the quiet rhythm of a life you built on your own terms. You sit on a pile of millions, knowing that the heavy lifting is behind you. This is the goal. You have crunched the numbers, mapped the trajectory, and locked onto a specific target, 70,000 NTD every single month. It is enough to cover every bill, every desire, and every whim, all flowing into your account like clockwork. You see it clearly. The ETFs are performing, the dividends are hitting, and your lifestyle is fully funded by the machine you constructed. It feels like the ultimate victory. It feels like the finish line. You have calculated the yield, you have tracked the growth, and you have built a plan that seems as solid as the island itself. It is a peaceful vision, a future where your capital works for you while you simply enjoy the view. You are not just saving. You are securing an early retirement that lasts a lifetime. Everything is set, the path is paved, and the destination is within your reach. You look at your brokerage account and see order. You see stability. The strategy is simple. Accumulate high-yield ETFs and let the payouts compound into a permanent bridge to independence. You have researched the top performers, the ones with double-digit yields that keep the cash flowing. Every month, the notification hits your phone, confirming the deposit. It is a tangible, reliable pulse of income. You do not worry about market volatility because the yield acts as your anchor. You have chosen the path that prioritizes immediate, predictable returns over the speculative noise of the broader market. It is a paved road to freedom, built brick by brick with every share you purchase. You trust the math. You trust the consistency. You trust that as long as those dividends continue to drop into your account, your retirement remains untouchable. This is your engine. This is your logic. You have convinced yourself that this specific approach is the most efficient way to turn your hard-earned savings into a lifetime of leisure. It feels foolproof, a mathematical certainty that guarantees your future remains secure, comfortable, and entirely under your control. But look closer at your brokerage account. Strip away the confidence and examine the actual numbers behind the screen. You believe you have mastered the system, yet you are missing a critical detail that threatens to dismantle everything you have built. The reality is not a paved road to freedom. It is a blind march toward a financial cliff. You are walking directly into a wealth-destroying trap. The peace of mind you feel is a fragile illusion, constructed from numbers that do not tell the whole story. If you stay on this trajectory, you are not securing your future. You are actively eroding it. The skepticism should start right now. Why does the account fluctuate the way it does? Why is the principal failing to grow in lockstep with those steady payouts? You are standing on shifting sand, yet you believe you are on bedrock. It is time to stop looking at the notifications and start looking at the mechanics of your holdings. A correction is coming. And if you do not shift your focus, the dream of an early retirement will dissolve into a desperate scramble to save what remains of your capital. The warning signs are already there, hidden in plain sight, waiting for you to acknowledge the danger before it is far too late. Those double-digit dividend yields you celebrate, they are not profit. They are a carefully crafted marketing illusion. When a fund boasts about massive payouts, they are rarely creating that value. They are harvesting it from your own pocket. You are essentially paying yourself with your own money, and the fund managers are taking a cut for the privilege of shuffling it around. Think about it. Where does that cash actually originate? It is not always from corporate earnings or sustainable growth. Often, it is a forced return of your own principal, packaged to look like a return on investment. The marketing departments know exactly how to trigger your greed. They dangle high percentages in front of you, knowing you will ignore the fine print. You see a green deposit notification and feel a sense of accomplishment, but you are actually watching your net asset value bleed out. It is a shell game. You are being handed a portion of your own capital, convinced it is a bonus, while the fund slowly hollows out your foundation. You are not growing your wealth. You are liquidating it, one monthly payment at a time. The trap is set, the bait is your own money, and you are the one pulling the lever. Fast forward 10 years. You wake up on a Tuesday morning expecting the familiar chime of your monthly dividend deposit. It arrives, but the amount is smaller than it was last month, and significantly less than it was 5 years ago. You pull up your brokerage account. The numbers are jarring. Your total portfolio value has cratered. You look at the balance, expecting to see the growth you were promised, but instead, you see a hollow shell of your original investment. That monthly check you once celebrated, it now barely covers the cost of basic groceries. The dream of an early retirement in Taiwan has evaporated, replaced by the cold reality of a shrunken balance sheet that cannot sustain your lifestyle. You realize then that every payout you received was a piece of your future being stripped away. You are left with a portfolio that has lost its power to compound, trapped in a cycle where you are forced to watch your capital dwindle while the cost of living climbs. The road you thought was paved with freedom was actually a slow, systematic dismantling of your security. You are not retired. You are not wealthy. You are just holding the remnants of a strategy that traded your long-term survival for a temporary false sense of comfort. Let us strip away the marketing and look at the raw, brutal math. When a fund pays out a 10% dividend, that money does not manifest from thin air. It is pulled directly from the fund's assets. On the day that dividend is paid, watch your brokerage screen closely. The share price drops by the exact amount of that distribution. It is not a coincidence. It is a rigid, unavoidable, mechanical correction. If the fund shares were priced at $100 and they pay a $1 dividend, the price instantly resets to $99. You have not gained money. You have simply moved a dollar from your capital bucket to your cash bucket. The total value of your position remains unchanged at the moment of the payout. The real damage happens when the stock fails to recover that lost dollar. If the market stays flat, your principal stays lower. Each month, that cycle repeats. You receive your cash, the share price dips again, and your core holding shrinks further. You are celebrating a deposit while your actual ownership of the underlying assets is being whittled away, cent by cent, payment by payment. You are essentially eating your own seed corn and calling it a harvest. Now consider what happens when the market stalls. Your high-yield fund has no organic profit to distribute, yet it is trapped by its own marketing promise of consistent, high payouts. To keep you from selling, the fund manager pulls a desperate maneuver. They dip into the net asset value of the fund itself. This is the point of no return. You see the dividend hit your account, and you feel the temporary relief of cash in hand. But look at the chart. The fund is no longer just adjusting for a payout. It is bleeding. Every month that the market fails to provide growth, the fund cannibalizes its own reserves to keep the yield looking attractive. You are watching a slow-motion liquidation of your portfolio. Your core holdings are being chipped away, sold off to fund the very payments you are using to pay your bills. The mathematical reality is undeniable. Your share count remains the same, but the value supporting those shares is vanishing. You are not earning a return on your investment. You are paying yourself back with your own shrinking pile of money. It is a hollow victory, a cycle of self-destruction where your principal dissolves, leaving you with nothing but a smaller, weaker foundation for your future. Just when you think you have finally secured your payout, the taxman arrives to claim his share. This is the hidden blade in your high-yield strategy. In Taiwan, those dividends are not just cash, They are classified as personal income. If you are sitting in a 20% tax bracket, the math turns hostile. Every single payment you receive is immediately sliced by 1/5. You are not just dealing with the erosion of your principal. You are now paying a premium to watch your wealth disappear. That money was yours to begin with, yet it vanishes the moment it hits your account. You see the deposit arrive, and before you can even plan how to spend it, the state has already taken its cut. This is not investment. It is a structural drain on your potential. By chasing these distributions, you have walked directly into a tax trap that keeps your capital from compounding. You are effectively paying high taxes on money that is already shrinking in value. It is a double-sided blow to your net worth. Your principal is being cannibalized by the fund, and your remaining cash is being harvested by the tax system. Your wealth is being bled dry from both ends, leaving you with nothing but a smaller, weaker portfolio. The taxman is only the beginning of your losses. Just as you recover from the sting of that 20% income tax deduction, the second-generation National Health Insurance Supplement kicks in. This is not a choice. It is a mandatory, automated extraction. Every dividend payment over a certain threshold triggers this additional levy. It is a structural trap, a hidden surcharge designed to bleed every cent of your distribution dry. You are now paying a tax on a tax, effectively funneling your hard-earned capital into a state-run drain. It is relentless. You check your brokerage portal and see the gross amount, but look at the net result after these two distinct bites are taken. The gap between what you expected and what actually lands in your pocket is staggering. You are not building a retirement. You are participating in a system that systematically dismantles your returns before they ever touch your bank account. This is the reality of the high-yield model in Taiwan. It is not just the fund cannibalizing your principal from the inside. It is the regulatory environment stripping your cash from the outside. You are fighting a war on two fronts, and you are losing on both. Your wealth is being harvested, piece by piece, until the engine of your financial future is left completely hollow. If you are constantly pulling cash out, you are killing the only engine that creates real wealth, compounding. Real growth requires your returns to stay inside the machine, where they can generate their own returns. By demanding these forced distributions, you are effectively cutting the legs off your own portfolio. Imagine a treadmill that is slowing down every time you increase your pace. That is your current strategy. You work, you invest, you trigger a payout, and then you pay taxes on that money. Because the money leaves the account, it stops working for you. It sits idle, or worse, it is spent. You are trapped in a cycle of constant, shallow harvesting. You can never reach the point where your wealth hits the exponential curve because you are shaving off the top every single month. It is a slow, grinding decay. You see the numbers on your screen and think you are making progress, but you are merely running in place on a treadmill that is losing power. You are not building a fortune. You are dismantling your future piece by piece. The math is brutal. Without the fuel of reinvested capital, your growth will never accelerate. You are stuck in a loop of stagnation, forever chasing a payout that keeps your wealth small, brittle, and unable to weather the coming years. Stop. There is a different way. Pivot your focus from distributions to pure structural growth. Real wealth is built through assets that expand in value, not those that force cash into your hand. Compare your current high-yield trap to market cap-weighted growth stocks. When you invest in companies that increase their earnings and market share, you are holding assets that work for you in silence. They do not trigger annual tax traps because they do not force distributions upon you. Your money stays invested, growing tax-free and compounding over time, without the constant interference of the taxman. While the high-yield investor watches their principal erode, The growth investor sees their base expand by 8 to 10% annually. It is a fundamental shift in logic. You stop looking for a monthly check and start looking for an expanding balance sheet. This is the moment of clarity. You are no longer chasing the illusion of a payout. You are choosing the mathematical reality of total return. By aligning with growth, you disconnect your wealth from the systemic drain of forced payouts and place it firmly into a structure designed to scale. The difference over a decade is not just a few percent, it is millions of NTD in your pocket. Consider the tax code. It is the silent partner in your portfolio. In Taiwan, dividends are hit by personal income tax and the second-generation health insurance supplement. That is a double tap on your wealth. But look at capital gains. They are not taxed as income here. This is the hidden advantage, the massive strategic loophole that most investors ignore. When you hold growth assets, your wealth expands in the shadows of the taxman. You gain 8 or 10%, and every single cent of that increase stays inside your account. It stays invested. It keeps compounding. You are not handing over a slice of your growth to the government every year. You are keeping your engine fueled. If you choose high yield, you are essentially paying for the privilege of being taxed on your own principal. If you choose growth, you are capturing the full force of market appreciation. It feels like a cheat code. You are building a larger base, year after year, with zero friction from the tax authorities. By avoiding the dividend trap, you retain complete control over your liquidity. You only sell when you want, and only what you need. This is how you outpace the average investor. You are not just picking stocks, you are outsmarting the system by keeping your returns where they belong, in your pocket. Let us crunch the numbers over a decade. Imagine two investors starting with the same 5 million NTD. Investor A chases a high-yield dividend trap. Each year, his principal is cannibalized to pay his monthly check. After 10 years of tax hits and eroding share prices, he sits on essentially the same amount he started with, or perhaps less. His purchasing power has been shredded by inflation. Now look at Investor B. He ignores the siren song of dividends and stays in growth assets yielding 8 to 10% annually. He does not pay a cent in income tax on those gains. He keeps every dollar reinvested, compounding at full force. By year 10, his base has not just expanded, it has doubled. The gap between them is not a few thousand, it is millions of NTD. Millions. That is the cost of your comfort. That is the price of choosing the illusion of a monthly check over the reality of exponential growth. You are looking at a future of stagnation versus a future of true freedom. The math is cold, the data is undeniable, and the difference is massive. You can keep chasing the yield, or you can start building the millions you actually deserve. The solution is not more math, it is a shift in strategy. You must move away from the high-yield trap and adopt a dual-core approach. This is your blueprint for structural wealth. First, you anchor your portfolio in broad market growth funds like 00850. These instruments capture the systemic expansion of the entire economy, ensuring your capital is not tied to the performance of a single sector. You are betting on the market itself, not on a forced distribution formula. Second, you pivot toward world-class semiconductor leaders. These are the companies that underpin the global tech infrastructure. By combining these two cores, you build a foundation that prioritizes total return and long-term appreciation. This is not about chasing yield. It is about aligning your assets with real, measurable growth. You stop looking for a monthly check and start looking for a rising base. Every dollar you put into this dual-core system is a dollar that compounds without tax friction. You are building a machine that grows while you sleep, shielded from the erosion of dividend payouts. This is the new reality of your portfolio. It is efficient, it is logical, and it is built to last. You are no longer gambling on marketing gimmicks. You are investing in the bedrock of the modern economy. Now, look closer at the engine of this growth. If you want to align your future with the bedrock of the global economy, you look at ticker 2330. TSMC is not just another stock. It is the physical foundation upon which the modern tech world is built. Every high-end processor, every advanced smartphone, and every piece of artificial intelligence infrastructure runs on chips forged in their facilities. When you hold 2330, you own a piece of the most critical manufacturing process on the planet. You are not betting on a marketing promise. You are betting on a global necessity. While high-yield funds cannibalize your capital, 2330 reinvests its massive profits into next-generation technology, expanding its lead over every competitor. By dollar-cost averaging into this asset, you are buying into the reality of global technological expansion. You are capturing the value created by the world's most sophisticated machines. This is the difference between chasing a superficial dividend formula and owning the actual engine of progress. Stop looking for payouts that erode your principal. Start accumulating shares in the company that powers the future. This is the core of your wealth-building machine. It is tangible, it is dominant, and it is the most logical place for your capital to reside. Now you have the growth engine, but you still need cash for your life. Do not fall back into the trap of forced fund distributions. When you rely on a fund to pay you, you lose control of the timing and the tax consequences. Instead, you become the manager of your own liquidity. You decide when to sell, and you decide how much. When you need money, sell a small, calculated percentage of your growth portfolio. By selling capital, you bypass the income tax bracket that swallows dividend payouts. This is a critical distinction. Your money stays invested in high-performance assets, compounding over time, while you only harvest what you actually need. You avoid the second-generation health insurance supplement and the heavy tax cuts that drain your account every single year. You are keeping more of your capital working for you. You are not waiting for a fund manager to decide your payout. You are executing a precise transaction on your own terms. This is how you maintain a self-sustaining machine. You control the flow. You minimize the tax friction, and you ensure your base continues to expand. This approach is efficient, it is calculated, and it puts the power back into your hands. Stop chasing the psychological comfort of a monthly check. That check is an illusion that costs you your future. When you stop relying on forced payouts, you stop being a passenger in your own financial life. You are building a self-sustaining machine. This is not about luck. And it is not about finding a magic fund. It is about the mathematical reality of total return. Every dollar that stays invested is a soldier working for your future. When you move to a growth-oriented strategy, you stop the erosion of your principal. You protect your purchasing power from inflation and taxes. This is the shift that changes everything. You no longer watch your portfolio shrink while you celebrate a small deposit. Instead, you watch your base expand year after year, with the force of compound interest working in your favor. This is the definition of security. It is not about the illusion of a steady income. It is about the reality of a growing fortress. You are now in command of your liquidity, your taxes, and your long-term trajectory. You have replaced a flawed, marketing-driven system with a structure built on efficiency. This is the difference between surviving on scraps and building an unstoppable engine of wealth. You are finally playing the game by the rules of the wealthy. The time for theory has passed. You need to open your brokerage account tonight. Look at your holdings with a cold, analytical eye. If you see instruments that pay double-digit yields, you are looking at a wealth-destroying trap. These funds are not growing. They are cannibalizing your principal to pay you back with your own money. Every payout you receive is a silent step toward financial depletion. You must isolate these positions immediately. Ask yourself one question. Does the underlying value of these assets grow, or does it stay stagnant while the payout stays high? If the answer is stagnant, you are holding a liability. Pivot now. Do not wait for the next market cycle or the next quarterly statement. Sell the instruments that erode your base. Reallocate that capital into assets that prioritize total return and long-term appreciation. This is not a suggestion. It is a necessity for your survival. You are the only person responsible for the integrity of your portfolio. If you continue to ignore the math, you will pay the price in lost potential and a shrinking future. Take control of your assets, identify the drain, and cut it off. Your financial independence depends on the actions you take this evening, not the excuses you make tomorrow. Now that you have cleared the clutter, you can finally build. Forget the glossy brochures and the hollow promises of high-yield marketing. Those are traps designed to keep you distracted while your capital bleeds out. True financial strength is built on efficiency and mathematical reality. When you look at your new portfolio, you should see assets that function like clockwork. Every dollar must serve a purpose, either to grow or to protect. A fortress is not defined by how much it gives away, but by how much it retains and compounds. You are no longer chasing the illusion of a monthly check. You are creating a system that beats inflation by design. This is the difference between a house of cards and a structure that endures. Your wealth is now a reflection of market growth, not forced distributions. You have traded short-term psychological comfort for long-term power. When you operate on these terms, the market becomes your engine, not your adversary. You have the clarity of someone who understands the math behind the money. You are no longer guessing. You are calculating. Trust in the structure you have created, because it is built to survive, to expand, and to sustain you for decades to come. The transformation is complete. You have discarded the illusions of forced payouts and replaced them with the cold, hard logic of growth. You are no longer chasing the temporary comfort of a check that steals your future. You are the architect of your own financial independence. This path requires discipline, but it offers something far more valuable: the certainty of compounding power. The decision to pivot is the hardest step, but you have already taken it. Look at what you have built. This is your engine. It is designed to withstand the market, to outpace inflation, and to secure your freedom. Do not look back at the traps you left behind. Your focus is forward, on the growth that lies ahead. If you are ready to break the cycle, if you are prepared to defend your wealth with this new, unstoppable engine, there is one final step. Leave a comment saying, "Ready to win," below. Let that declaration be the stake you drive into the ground. It is time to claim the financial future you have earned. This is your journey, your strategy, and your victory. Begin now.